All right. All right. Enough of that. How you doing, friends? It is Friday, October 7th, and this is the final hour of 0 days to expiration. How about some cheering from the fans? Ah! Woohoo! Things are crazy out there. Today, right now, as we speak, there are special things going on. The market is in a place that, well, it's on the edge. It's on the edge of the abyss. And here's the thing. I know, and we all know, where this market's going. We all know. It's going down, and it's going to go down hard. And the only question, really, is how bad is it going to be? We know it's going to be bad. We know, at least according to Uncle Jerome, that we're going to experience pain. A lot of pain. Yeah, let me pull these down a little bit here. There we go. Hold on a second. Okay, I'm back. Let's see, I get these out of the way with the camera focus. All right, perfect. Hi, Obi. How you doing, buddy? Oh, yes, I do. Okay, yeah, he was watching the turkeys out in the backyard. He wants to go out now. I know you do. You want to go out and get the turkeys. Have turkey dinner. All right, that's enough. All right, as I was saying, the market, and everybody knows where we're going, and it's going to be tough. The only real question, well, there are two real questions: is how fast are we going to get there? When are we going to get there? And just how bad is it going to be? How long? Well, there's another question: how long is it going to last? And and there's all kinds of different speculations that we could make. I think that one of the things that's becoming a realization is that not only are we going down, but it's going to be a lot harder than we thought. And you can really tell that in the progression of how the Fed has, and also the Treasury and everybody else that are, quote, pundits and the experts have characterized our slide down here. The interesting thing is that, they all started out with things are under control. At first it was inflation was too low. We got to get inflation up there. It is so important. So we're going to, basically turn the heat on. And then it started to rise, and everybody knew that this was just crazy. It didn't make any sense. Inflation kept on rising, and then, of course, the really outrageous energy policies and other policies that were going on, and the spending that was just going out of control. You knew what was going to happen, what was the eventual outcome. And while the Fed is trying to, I guess, what would be the right way? Commentate this, what is happening, but absolutely the poorest commentation whatsoever. And then they finally came to this notion that things were transitory, and then there was peak inflation, and now there's pain. All right. So I'm not sure what the next chapter in this commentating is. What comes after pain? So we know that they know it's going to be really bad. I like to say that we know that they know that we know that they know things are bad. That's how bad things are. Yet they still lie. Why? I think that was a quote from some book somewhere. Maybe somebody can help me out on that. But things are going to get bad. And what does that mean to the average person? For the average person, that is tough. For people that have at least some means, it's not going to be so bad. You can weather things. It really depends on where you are in terms of your stability. if you're stable, you own your home, you have some money in the bank, you have a steady job, you can pay your bills. Even if you don't have a job, but you can still pay your bills, you're okay, right? But that's a very small percentage of the people. The rest are going to go through a lot of strife, a lot of difficulty, and it's sad. It's sad. It didn't have to be that way. We're a product of our own making. I don't, that's where we're going now. From from my point of view, and from what we're doing here at Zero DTE, I believe that we have a strategy that is completely recession proof, completely um, even depression proof, quite frankly. If you have some, now the only thing that we can't guard against, or the thing that we're always what we can't get ahead of and how bad it could get, is inflation. If inflation just gets so bad that there's really nothing that you can do, you can try to keep up with it, and that's about the best you can do. But I believe that our strategy here is probably the best strategy of all, because we are working on these asymmetric principles, tiny, tiny little risk. So our drawdowns are absolutely minimal, and taking advantage of those chaotic situations when they come up and profiting from them. It's from a psychological point of view, from a capital efficiency point of view, it is perfect. And we're never really worried about that downside. As a matter of fact, days like today, I didn't find there's really nothing about today that worries me. And I'm worried for everybody and the general condition of the country and where we're going. Absolutely. But, for our trading, nah. I mean, there's nothing that can really knock us off of a pillar. There is no move that can ruin our day. That's the crazy thing about this. That's the great thing. There is nothing that can knock us off of a position where it would hurt, because our positions are never big enough to hurt. So that's that. So I was doing a little research on the Great Depression, because some people are actually using that as a potential. There are a lot of people that are saying that, yes, we're going to go into a recession. It's going to be much worse than what we thought. And many think that it's going to be even worse than the, quote, Great Recession of 2008. And that's a good potential, because in 2008, there was only one market that really bust. But in today's day, we have multiple markets and industries that are going to bust. Housing, auto, credit, it's all coming down all at once. So that's going to present some particular hardships. Energy, well, that's not really busting. That's going the other way. Just recently, let's see, I got to see where the market is. I haven't looked at it for a little while. Where are we? Really hasn't changed. Very cool. Positions are doing fine. Everything's cool. As a matter of fact, my position's probably going to trigger any moment. So where was I? Oh, I know. Roll call. We got to see who's in the peanut gallery. All right. So first on the list, we have Brent. How you doing, Brent? And then Dan. Dan, you missed the number 1 spot again. I'm losing faith here. Yesterday you were number 3. Today you're number 2. Tim Dodds, howdy. Tim says my 5 wide 3700 ain't gonna make it. Well, anything 5 wide. I mean, that's a lottery ticket. Let's face it. And you couldn't have paid too much money for it. Now I'm really not too much different. I have a 15 wide, which is not particularly wide, but in these times, in this type of market, what happened today? Let me just sort of back up here. What happened today with the unemployment report is that we broke the cycle of this bear market rally. From my point of view, bear market rallies are absolutely the worst environment to trade in. They're even worse than the super low liquidity markets. At least then you have at least some stability, and there are patterns in the randomness. In this type of market, there is really no way to sort of judge what is going to happen or what's going on. People from a psychological point of view are somewhat relieved, but still worried and anxious that we came down from this long, protracted bear market, and now we're on a rally, and there's hope, but the hope is guarded. And then, of course, at any point, you're getting all of this conflicting information, and you're wondering if I can hang on to this, or should I? And so, from that point of view, and also from the fact that randomness and the patterns that you see in that randomness are no longer there. The clusters in the randomness dissipate, and it becomes more frothy. And so that's an extremely difficult environment to trade in. So what we do really is we go from trading small, like we normally do, to trading even smaller and more selective and guarded. It's kind of like I made this analogy in the room. I said that it's a lot like how I drive. I drive normally, like you do normally, go a little bit above the speed limit and be on guard with everybody that's around you. And then I drive defensively. And in New England, you have to learn how to drive defensively for two reasons. One is there's a lot of batshit crazy people out there, or brain dead people, that have no idea of the rules of the road, particularly when you get into a rotary, or what some people call a roundabout. No one knows how to do that. No one knows who has the right of way when they come to an intersection in Massachusetts. Why is that? I have no idea. And then the other problem that you have in Mass in driving is the weather. Our weather can get pretty nasty with nor'easters and snow and black ice and all of that. So you have to learn how to navigate that. So on one hand, you've got all the crazy, batshit crazy people out there, and then you've got the crazy weather combined, and that's a lethal combination. So you have to, get super, super defensive and drive slower. It's really, those are the two modes: cruising along and then driving slower. So same thing in trading here, particularly with any kind of asymmetric strategy. You either trade small or you trade super small, right? It's pretty simple. We don't have to really lay it all out on the line. We just have to be deliberate and consistent and picking our spots, and that's pretty much it. It's easy. Oh, I missed, got sidetracked again. Back to the peanut gallery. All right, see, we have Tim Dodds. How you doing? Yeah, I already said that's where I left off. We have Matt. Happy Friday. Yes, it is a nice Friday. Reza, how you doing? And Clayton's here. Vadim, how's it going? And Jim S. And I'm sure there's many more out there. If you want your name called out, just say hello. So why don't we take a look at the markets today and check out this thing that basically broke the back of the bear market rally. Like I said, bear market rallies are absolutely the worst. They're the toughest environment, both psychologically and also technically to trade. So let's go to the charts. Oh, that's the trade that I have on. Let's go to the chart. There we go. All right. So what you're seeing here is the volume profile and the market, and it looks like we're showing about a few weeks worth of data. And this T0 right here is identifying this value node or volume node. And that's that's the predominant volume node before we go down below the June lows. Now this would, these two moves right here were the absolute lows over the past year and a half or so. they exceeded the June lows. The June lows are really at the bottom of this value node or volume node, and we're down below that again. And of course, if we can get down below these lows here and through these LVNs, there's really nothing down below us from there. It's extremely light in terms of liquidity, low liquidity, lots of room to run. When you see running markets like this, that's usually a sign of low liquidity. So let's go back to a day chart so we can see exactly what we're dealing with here. All right, this big area here in this lack of volume nodes, what we call a volume well, is really the issue. There is nothing holding price back. Once it gets below this little green line, this little mint green line here, there is very little liquidity, very little to stop us from going down. Let's take some of this stuff out of the way so we can see it better. All right. So T0 is really the last line of defense. Now you can see that this green line that I have here, where our last low came to after it broke through the June lows, that's right here. That green line, if you look how it's lined up with what we call an LVL. All right, so within a low value node, now in normal volume profile parlance, you have volume nodes and then you have low volume nodes. So the industry standard then is to look at, say, something up here around 4,050. That is considered a low volume node because it looks like the antithesis or the mirror of a value node or volume node, right? Like this one right here at 4150. And then 100 points down, we have this absence. But they're not really, that's a misnomer. And a lot of people are not paying attention to what's happening in these low volume nodes. Now, I don't call them low volume nodes. I call them volume wells because ultimately that's what they are. They are deplete, or they're, you have to go deep down to find volume in a volume well. And so there's really nothing there, and hence there's no liquidity. A better way to say it is that there are much fewer players with orders sitting out there trying to control your money in these areas. And so for that, and because of that, price tends to move through those areas very quickly. And you can see that very clearly on all of these charts. So if you look right here, just a couple of bars move straight through there. Right here, a couple of bars move straight through there. Here, and go way back here too, just a few bars. See, for whatever reason, the market doesn't like that area. And it's the same deal over here too, right? Now, it's not quite as pronounced, but these are relatively low volume moves here between here and here. And so you have that kind of activity. And so when you get into one of those, price tends to really move fast. And so those volume wells are the places where most markets are trending. And then the volume nodes are where where the market is consolidating. And I mean, that it's not like rocket science here. That's obvious, right? The reason why there's a volume well or volume node there is because price is hanging out there. The market has found value and decides to go back and forth and spend a lot of time there. And then hence it creates a big spike in volume there. And so that's where the market has found value, where there's equanimity. Everyone feels good there. And then once they get out of their comfort zone, it's like, holy crap, where are we going? Right? That's what happens. And because there's no ground, there's nothing to step on. It's, it's like you're on a ladder and you go to reach down and there's no next rung there. That's what happens. People get panic stricken. And now here's the thing. These big players that are out there know this. And so they set lines in the sand where, or rungs in the ladder where you can step on, and they can control whether or not that rung in the ladder is going to be solid, or if it's going to be kind of a trick rung and it will break away. Right. And so that's what these low areas are. And that's what I have identified with these mint green lines. Right. So I'm going to have to start adding to these, because there is another one. Yeah, I'll just move it down right down here. And all I have to do really is identify these very, very low areas like that. And this one way down here. And this one's tough to see. There is one right here, but I think this edge is probably more prominent right there. And so why am I doing this? I'm doing this because they become markers for us when we're figuring out our scenarios and where price is likely to move. So every morning I do an analysis of the markets and I look at what energies are coming into the market. I take into consideration the market structure, which I am creating right here. What I just did right in front of you, that was creating a market structure. That's telling me where those features are. And the reason why I do that is because those features also identify very clearly. And if you had a program like Bookmap or some other place where you could see the actual orders lined up in these spaces, you would find that they're all lined up along those areas, along those little lines. That structure, that is what's actually creating the structure in the market. It is like a physical structure, like a landscape. And so we have flat plains, then we have hills, flat plains, then hills, and it's all along here. Now, of course, this big, huge area here is one big flat plain with a bunch of divots in it. That's the way I like to look at it. And then the volume nodes are like the hills that are and mountains that are at the edge of the plains. It's kind of like, I was out in the desert a couple of years ago in California at Anza Borrego. I don't know if you're familiar with that, but when you first get out there and you're coming off the coast, you have to drive through the mountain range, and you get through the mountains, and of course you're winding and all over the place, and you come out to the desert and there's just nothing there. It's just flat forever. And you're going, and you want to make sure you get through there as quickly as possible. Now, in our case, we were going to Anza Borrego, which is a town that's right in the middle of the desert, and it's out in the middle of nowhere, and we want to make sure that we can get there. And so you go like a bat out of hell. You make sure you have plenty of water with you, et cetera, et cetera. Of course, if you get to the town and it's a little oasis and you can stop there and it's cool. But on the far side of the desert, you can see the mountain ranges, and that's what that's exactly what these volume nodes are like. You go quickly through the desert, and then you get to the mountain ranges and everything slows down. You can take a load off, hang out for a little while. So that's the way the market behaves when it's in a volume well or on a volume node. It finds nodes, it hangs out a while. When it comes across these, what I call LVLs, these low value levels, those areas, those are kind of like little traps. They're gateways. They're I don't know, maybe you can call it the crossroad on that road through the desert. It's the crossroad out in the middle of nowhere. And for whatever reason, somebody out in the middle of nowhere where there's not 10 miles of anyone anywhere and no cars coming, there's a stupid light there. and either that light is green or red, right? And if it's red, you got to stop and hang out there. If it's green, you can pass right through. So that's kind of like what these guys are. I'm constantly searching for analogies here and metaphors, and that I don't know if you just heard that beep, by the that dring. That was my my trade going off, and apparently it just filled, and that means that I've made my profit for the day. All right. So, anyways, let's get back to these guys here. When you zoom in on these guys, let's zoom in. You will find that now I create these at that level, at the day bar level. I can't see this kind of detail when I zoom in. But you'll find that everywhere where I put these lines, there's definitely something going on there with price. I mean, price tends to find those lines, as you can see here very clearly, and is finding that those are structural areas where the market pays attention to. I mean, that it couldn't be clearer. And it's really beyond me that other volume profile pundits or experts, so-called experts, don't see this. They spent all their time in session profiles as if that is what is controlling the markets. And it's not. It is these big, huge structures. This is where the market is, and here I am looking at this stuff, and it's clear as day. We're finding it. Markets tend to, accumulate in the volume nodes, and then they find support and resistance at the edges of nodes and at these LVLs. That's what's happening. It's so obvious. So, anyways, every morning I provide a market analysis, and that is comprised of looking at the overall global macroeconomic condition, looking at futures, looking at economic reports coming out, reading the news the overnight and see what's happening, looking at the overnight market action and see where that's going. If there's a huge downtrend overnight, I probably want to know why. Did it happen at the European Open? Because at 3 o'clock here on the East Coast, 3 a.m. is when the Euro market opens. Earlier that evening, the previous evening at 9 something, you have the Asian markets open. So you're looking for these opens, and typically there's more traders coming in doing stuff. There's also economic reports that are coming out all across the globe in different places. There's different central banks and their governors coming out and talking and giving speeches or saying something totally insane, which is par for the course. And so they are putting the energy into the market. So you come out later, early in the morning here, usually around 7 o'clock. I get all this stuff together, and I make an analysis of it and where I think the energy is going and what economic reports are coming out, so that we can at least flag those times and know what to expect. And then look at the market structure. And then from there, I can develop scenarios. And you've seen this if you've been watching my videos. I'll have these little arrows pointing to different things. Not these arrows. These arrows where I actually had text and I was just pointing out some things for some people. I removed all the arrows from today, but I create these arrows, and those are my scenarios. I create a bullish and a bearish scenario every morning. Every morning, create a bullish and bearish scenario that basically follows the lines of these LVLs and the volume nodes and all that. And from that, now I have no crystal ball. I don't know where price is going to go. I have an idea what kind of energies have come into the market, whether it's more bullish or bearish. But I still don't know when the market opens if we're going to react and go the same direction or do a reversal or whatever. So that's why I create both a bullish and a bearish scenario. And then once the market reveals itself, and we've gone a little bit into the market, maybe around 10 o'clock or so, we start getting a more solidified view. Volatility may have resided, pulled back a little bit, or it didn't. Like this morning, it didn't. It just kept on going. Boom, 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 boom. Because we had this really bad employment situation report come out. Now, was it really bad? Or was it really good and we're in opposite world and that made it bad? In this case, it's opposite world territory. We're in opposite world territory. Because good is bad and bad is good. Why is that? Because anything good that would normally feel good in a market, in a normal market, will cause investors to think that the Fed is, because they're in this heightened reality, this bizarro world reality, that if things are good, that means that inflation will continue to expand and they must dash it and crush it at any cost, no matter what, even if it means killing the market and killing jobs. as Jerome Powell actually said. That's exactly what his intent is, the exact opposite of what the Fed's prime directive is, and that's maximum employment and stable markets. No, they are looking to destabilize markets, drive them down, and quote, in their words, soften the labor market. Right? So when you have what appears to be a strong labor market, Wall Street freaks out. They freak out. They say, "Oh my God, strong labor market, we're all going to die." No, what they're really saying is the Fed is going to continue with their QT, their quantitative tightening, and continue with their increasing of interest rates in an attempt to kill the market and kill jobs. And so, from an investor and a trader point of view, that means that all of their investments and everything have now just been devalued or lowered because of their future expectation of what that means when the Fed does come to their next meeting, which is going to be on November 3rd, and they decide to raise interest rates again. As a matter of fact, let's see, based on this information, let's take a look at the Fed Watch tool. The Fed Watch tool. We're gonna go to the Fed Watch tool. There it is. And this will be the market and how they're pricing in whether there's going, what level of interest rate hikes that they're expecting. And so the odds right now, see the current, we're at 325 basis points, or 3% or 3.25%. You can see that right at the top here. Maybe I'll make this bigger so you can see that. All right. So this is the market pricing what they think the Fed's going to do. And this is a tool that is provided by the CME Group. They are the stewards of most futures that we're all familiar with, like the E-minis. And on over here, they're giving it an 18% for a 50 basis point hike. See, 350 to 375. That's 50 points bigger than 300 to 325. Now here, they're giving it an 81% chance of going to 75 basis point hike. Now, what's interesting is they don't have 100 here yet. And just yesterday or the day before, these two bars were almost equal. They were half and half. Today, that's changed dramatically. So see now what they're saying is that, oh, we think the Fed's going to go for the full 75 points this time. And so, I think that, that's probably a good idea. But if we continue over the next month until the next meeting, which, as you can see up here, is on November 2nd, right there. See, it's up here. Oh, I can't select it. If things continue to get bad, or if we have reports that employment continues to get better, or economic conditions continue to get better, or oil continues to rise, or whatever it is, anything that they think will cause inflation to flare, or if we get some CPI numbers or PPI numbers or CPE numbers or any other numbers that keep track of inflation or come in hot or higher than expected, then this ratio or this prediction, the target rate probabilities for that November 2nd, 2022 Fed meeting, that will change. And my prediction is that they will continue that way. And we're going to see the 50 basis point prediction go away. And then that will be replaced by the 75 basis point. And then there will be another one where it'll be the 100 basis point. That's what I think. I think that's exactly what's going to happen. It's going to roll and get worse. All right. We have Happy Street. How you doing? All right. So there you go. There's the prediction. Whoa, things have been really dropping since I got on here. So I guess my trade was pretty good. So this was where I put on my spread because I felt when we were coming down hard. I put it on when we were way up here. And I felt like the market would be coming down hard, probably to the bottom of T0. I didn't know if it would go through. I had my suspicions, and so the type of um, the type of spread that I put on is called an unbalanced fly, which is actually comprised of a regular butterfly plus a uh, another vertical that is sort of slapped onto the side of it. And so once price got down below here and broke through that area, I took that vertical off, and so then it allowed me to profit even if it came down further, because after it came off, it looked like, yeah, that's what's going to happen. So so I can show you that. So this is the original fly, right? It's a put fly. Um, Quantity 1111. Oh, what's going on here? Here, this is what I want to show. Oh, I accidentally put a put that should have been a call. Oh well. All right. So I was trying to do the pattern day trader thingy, but apparently I put this out there and it took something off. But anyways, so here was my original trade for 55 cents. I limited it by taking a portion of it and using a pattern day trader hack that took the vertical away. And then I finally took the underlying fly away. So now there's just a vertical that has been zeroed out, basically. So all of that resulted in some level of profit. Looks like $155. So that's good. All right, let's go back here. Let's see, how does that look on the P&L analyzer? Did I do that wrong? I may have done it wrong. uh, no, I did it right. Yeah, $155. So that's cool. All right. Anyways, the market continues down. This is the next. This is one of the last lines in the sand. This would be this LVL. This is really the final line in the sand right here, 35.85. Once we come down here, and I don't expect that to happen until next week, then we're toast. We're gonna move all the way down. Let's see here, and then just to give you that big view. Go back to the day again. So what we're looking at, this is the 30. I'll make this a different color. Let's make that like a red for danger. So that's the line in the sand right there. Once we go down below that, I see us moving down relatively quickly down to this next level, which is 33.65, which is a good, man, it's 300 points lower. Well, not 300. We're at, let's see, we're right here, 360, yeah, 300 points lower. So yeah, that's the next landing area, I believe, for this market. Another 300 points down, and we can probably project even further than that, and say that once we get down to there, there's a fair amount. This is probably one of the bigger volume nodes that has existed, and that is at the top of the pandemic highs, and then this consolidation have are going to add a fair amount of support. So it's very possible that this is going to be the ending point, at least now, for the time being. But if we get below this, I don't think that anything's going to stop this market from going much lower. All right, so when you bring all of this in, that kind of changes the picture a little bit. So there's a lot of activity here. So I would say that once we get below here down to this 3370, 3350, that area here, I think that's going to be our resting place for a while. There's enough activity and footprint or shadow of past activity or volume or whatever, the more mountains where we're going to hang out here for a while and go back and forth, etc., until everything gets kind of sorted out. Now, could it go further down? Absolutely. And if it gets down below here, then that's a problem, I think. But that's craziness. That's crazy talk, right? Is that possible? Do we get down below 2,700? Of course, it's possible. I mean, we were there back in during the beginning of the pandemic. It wasn't too long ago, just 2 short years ago. So it is very possible that we get there, but it's hard for me to imagine. But I don't think many people could imagine the move that we've had so far. And I don't think that we're anywhere close to done. There are some well-known pundits like Michael Burry that think that we're only about halfway done. If we're only halfway done, that does bring us down to the pandemic lows. I think that that's probably about it. But who knows? And if we're heading towards what I alluded to in my thumbnail, maybe we are going down to depression levels. I really don't know. I mean, that's a horrible thing to try to speculate on, but I think you have to be prepared for any eventuality, right? That's what I think. Yeah, Matt says, get the parachute. So now, again, from my point of view, from a trader's point of view, I don't work per se. I have my own service here, and I work for myself. And I've got plenty of cash and own a home, so I feel stable, and I can make money during this area. So I'm not really worried. I'm really kind of worried about the cost of things. I mean, the cost of things are going to get off the hook, but it's not going to kill me. But there's going to be a lot of people here that have jobs that maybe those jobs will go away, and the price of things will get beyond their reach, and there's going to be a lot of hurting people. And GK says that there's a lot of geopolitical stuff going on as well. I mean, that just complicates things. Now, that is one of the reasons why. Let me bring the big head back in. All right. So, yes. And that is one of the reasons why I wanted to illustrate something from the Great Depression and what got us out of that Great Depression. Of course, the worst years of the Great Depression were between 1933 and 1936, I believe. I think that they consider that the worst, but it actually lasted right through into 1941. And so I think Herbert Hoover, he was president at that time. He became president after the Depression had already started, and then started instituting a lot of these plans to try to make it better. He couldn't really get us out of that funk. And then FDR came in, Franklin Delano Roosevelt. And then he was the only president that actually lasted for 4 terms. He was in office for 16 years, if you can imagine that. But all through that time. And then when what got us out of the Depression was what I think a lot of people recognize was the World War II. Now, I mean, that seems to be like the go-to thing if you want to get out of a really bad economic way, just start a world war. And that worries me right now, because what GK was alluding to is that there's a lot of political stuff, geopolitical stuff going on, in particular over in Russia and Ukraine. And man, we are pushing those buttons as hard as we can, and we may force something. Now, was it us forcing it, or am I? I'm not taking sides here. Well, I should. I'm an American. I don't want any of this stuff going on, but it just seems like our leadership is bringing us down a path that is just the wrong headed thing to do, and they're doing everything they possibly can to stoke those fires. So, uh, and maybe all of this is designed to combat what they already know, and that is this impending severe recession, possible depression that we're going to go into, and then this is the way to get out of it. But I mean, how much? What is the extent of a war that you can take that would? I don't even want to think about it, to tell you the truth. It's crazy. Yeah. So JP Sweet is saying one tactical nuke by Putin, we will be at 2,400 or worse. Yeah. Oh yeah, for sure. But what does that say about what will actually happen? What will our response be? Let's hope that's not what brings us down. I agree. I don't want to hope that, but it's just when you look at history, whenever we've gotten into really bad times, that seems to be the solution. Just charge into war, and then everybody rallies, and then everything goes away. They say wars are good for the economy. That's a hard thing to say, but it's true. Yeah, and yeah, and OPEC, they're pushing our buttons now. They just cut production on crude, and cutting production on crude, that's some heavy shit, man, because that is causing crude prices to go up. Let's check this out. Check this out. I haven't even looked at it today, but yeah, look at that. So this stepping down of crude prices since the summertime is the direct result of the administration releasing the strategic reserves into the economy, and thereby diluting or increasing the supply of oil and bringing its price down. And now we are depleting that reserve. Now that reserve there is meant as an emergency. That's what it's all about. It's a strategic reserve for emergency use only. It's not meant to be something to garner political favor by trying to boost up the economy and reduce inflation, which it didn't really work anyways. And so now OPEC has decided to cut production, and of course we've already cut production drastically and cut off all different types of means of picking it up again. And so we've gone from energy independent to completely dependent. And now OPEC, I guess that they're not on the greatest terms with our current president. They've decided to tweak it a little bit more, right, and cut production. And so that's bringing prices up. And so all of this work that was done with what was super cheap oil that we paid for in the strategic reserves is now going away. And so what's going to happen is we're going to have to replenish that, but we're going to replenish that at a much higher price. Much higher price. Right? And so, oh, please share the screen. There you go. So there's the step down of oil. This is crude oil. All right. And then just recently, OPEC announced that they're going to cut production by 2 million barrels a day. So the million barrels a day that we're pumping into the market, that gets negated by that. And so that will bring up the price of oil because there will be less oil in the market. And without that, now energy prices are largely considered a major factor in our inflation. And so if energy gets more and more expensive, then that's going to be a burn. That's going to be gas on the fire of inflation. And there's no doubt about that. So here we have inflation rising and markets All right, hold on. Let's get the effect here. Markets falling. Inflation rising, markets falling. That's called stagflation, which is absolutely the worst possible condition that well, not the absolute worst possible, but pretty close to the worst possible condition that we could be in. All right, so okay, GK first part of this thing says not to get too political here, but I think he's going to get political. But the problem is that the people that created these problems are the ones trying to solve them, not going to work. Yeah, that's very true. Yeah, and we're relying on them. Matt M says, "Who cares? Just print another $1 trillion." I saw a comment. It wasn't a comment. I think it was a video, or maybe it was a Twitter post. And yeah, it was a Twitter post. And the question was, well, if we can print all this money to handle all of these problems, then why are we paying taxes? Why not just print money to pay the taxes? Right? I mean, that's a good point. Why do we pay taxes? Why not just print the money? What difference does it make? Oh, I see. Matt was being sarcastic. He's speaking as the government. Yeah. And so that I'm adding to that sarcasm. Hey, why not just well, I'm not going to get into why, but yeah, they should just print it and let's just do away with taxes. I mean, what do we need them for? Just print the money. So it looks like we're getting a little bit of a reprieve here. Little move up, not a lot, but a little bit. Right. So we may have found a bottom, and look where we found that bottom. Right on the LVL that I drew in a big time frame. Right. So that goes to prove that my form of technical analysis of the markets is spot on. All right, there it is, right there. Boom. Boom. All right, now back to the big head. So we've got 353. I don't have a trade for this morning, for this afternoon. It is just too tenuous to sit here and try to figure out what would be a good trade to put on. I just don't know. We're down below this value node. Anything can happen. The market is reeling from what happened this morning with the employment report. Now, the employment report also, it was interesting because the top line numbers said that the unemployment has actually been reduced by a little bit. Then, but also the other thing that was reduced was the participation. So participation has gone way down. Where did those people go? Where are they going? Have they decided that they are just no longer going to be in the workforce? I don't know, but that probably had something to do with the total unemployment rate going down, and not a real number. But in any event, I think the market looked at that report very negatively, obviously, and then just took us out of it. The one good thing that I can say about what has happened over this, and that is this little thing here, this bear market rally. This bear market rally was really a problem. I called it the psycho rally earlier this week. And most bear market rallies are a problem because psychologically I think they really are the most destructive thing from a trader's point of view because you just cannot trust it. You get excited thinking, okay, maybe the market has turned around, they've turned a corner, but we all know that that's not the case. It's just this sort of pressure release valve, and we don't know when it's going to stop. And it goes up so fast that it doesn't make any sense. It's not ordered. It is complete chaos. And so while this is going up, at all times you're thinking, okay, when's it going to turn around? When's it going to turn around? And so you're making these bets, and you don't know if you should go long, if you should go short. And then finally, we go sideways, and then we get this news here that basically just cuts it off at the knees. So bear market rallies are the worst. Now, what we do here to combat them is we simply, as I had described earlier, go from betting small to betting smaller and becoming more defensive. Like I said, the two modes of driving here is normal mode and defensive mode, and looking out for all the crazy. So another bear market rally that we had problems with. Now, when I say problems, this is a high quality problem from my point of view. Bear market rallies are definitely difficult to navigate. Let's see. Let's get rid of all of these lines here. Those are session markers. We came down hard with this bear market, and then we had this bear market rally here. This whole debacle here was very, very difficult to navigate. This one here happened so quick that there was, I think it took a couple of trades. It only lasted a couple of days. But this guy here was very, very difficult. And I can show you evidence of that just by looking at my performance on this strategy. So that bear market rally actually was this sideways action right here. And so what happens during something like that? I had a lot of great trades. Things were going well. This was the bear market, and then we get into the bear market rally, and it becomes very difficult because we get all of these intraday reversals, and nothing seems to work. It's sort of chaos and no patterns inside of the randomness, as I wanted to say, or no clustering. That's a term that I have adopted from reading this this book by Benoit Mandelbrot, and it makes sense. He describes how when markets get untenable, that you lose the cohesiveness, if that's a way to describe it, or these patterns that are within the randomness that you can latch onto. And I'm sure that a lot of traders understand this too, that things tend to go in streaks or clusters. When bad news or good news or things happen, they tend to happen in clusters. And when you have these bear market rallies, those clusters seem to dissipate, making it much more difficult to find a place that you can put a trade on. And so you go sideways. And so for me, when I went sideways, I got to show the chart here. When I went sideways here, right here, it became frustrating. And we're getting near the end of that bear market rally, and I start to, as you can see, there are nice big moves here. I start to shrink my size, my position size, and get more selective. And as I started to go down here, and then that kind of turned things around, and I stayed small, and then things started to open up, and then I went back to normal, and then things just went out like that. So this here was the start of that short-lived bear market rally here in the last few days, this last week. And I haven't entered my last trades, but they are down here, and plus today's a little upturn, so that will add to that. So it started again. So I started to contract again. And so that's been my basic strategy. When you have a bear market rally, contract. If it's a bull market or a bear market, great, works great. Even super low liquidity markets, they seem to work great as long as it's moving in one direction, and no problem. And even pullbacks and all that, that's all fine with this strategy. And like I said, trading super small, you're never really getting into trouble anyways. It's just the consistency. But I find that those bear market rallies are tough to navigate. But on the other hand, I look at this strategy and our position sizing, it's so small that it never really hurts. So even with super tough environment, we're not really losing any money, or very little. Max drawdown here has only been 3%, which is that's crazy small. So there's the bell. So let's go back to the big head. So overall, the strategy is a real winner, and it keeps you sane. You never really risking much. You have good steady growth. I've been averaging about 6 or 7% per month, or something like that, right around there, and very low drawdowns, so you get a nice smooth equity line, very little volatility in your equity, and this is in really tough conditions. And this has been since last year when we had that sort of bull market, that big bull market, and then this year where we had a bear market and the bear market rally, and it survived through all of that. So, so the strategy I think is super solid. Now I've been trading a form of this for a long time, but it wasn't until I started this service and realized the benefits or this new opportunity with zero DTE and the S&P, particularly at when I first started, it was only going 3 days a week. Now it goes 5 days a week, so we have even more opportunity. It has been really an incredible experience, and everything's working out great. If you want to join, do the trial. There's a link below. Let's see. Yeah. So everyone has to give me stage directions when I'm going back and forth, because I start talking and then I forget, and I'm looking at my screen and I can see it, you can't see it. And then finally someone says, "Hey." But maybe that's what I should do. You're right. I've thought about doing that, about putting the screen of the charts and everything and just putting it behind me. Then I don't even have to worry about it. And if anybody is wondering, then I can just sort of fade out and you'll see it. So maybe I'll do that on the next show. But as it stands now, it was a good week. Not a hugely productive week, but it wasn't a bad week. Went sideways because it was a bear market rally. And next week, I'm looking for big things. Whether we're going down or up, it doesn't matter. And I want to thank everybody for showing up. Peace to you all. I don't know who this is, but peace to you all. I hope you all have a great weekend, and we'll see you on Monday. Oh, Music Man. Peace.